I greet you, ladies and gentlemen, as I commence this lecture on market efficiency. I trust and hope that you are well. I will now share my screen. So we are still covering the module Central Banking and Monetary Economics. And what we are looking at today is market efficiency. And we are going to just cover quite a number of things. So when we are looking at market efficiency, it locates us in the area of behavioral finance. We've got traditional finance and also behavioral finance. We can't avoid looking at behavioral finance when we are delving into issues of market efficiency. When we are looking at behavioral finance, it's a discipline which attempts to explain how decision makers take financial decisions in real life and why their decisions might not appear to be rational all the time or every time, and why sometimes decision-making by financial actors appears unpredictable or has unpredictable consequences. Obviously, this is in contrast with traditional theories like your efficient markets hypothesis, which assumes that investors make rational decisions. Another definition of behavioral finance is that it's a subfield of behavioral economics, which proposes that psychological influences and biases affect the financial behaviors of investors and financial practitioners. In addition, influences and biases can be the source of explanations of all types of market anomalies and imperfections, such as we see in markets such as stock markets, where from time to time we see severe rises and falls in the stock price, like what happened after Russia invaded Ukraine. Several stock markets worldwide experienced a shock. And there were these anomalies that were associated with the invasion of Ukraine by Russia. So there are quite a number of definitions, as you can see on my slides. One of the definitions is that behavioral finance is a field that arises or that tries to identify and explain biases that cause people to make irrational investment decisions or behave in a financially detrimental ways. The reason why I'm covering this is because from time to time we see the outworkings of positive and negative externalities, so to speak, in financial markets. And we see deviations from financial market efficiency. So we need to be in a position to rationalize these deviations from financial market efficiency. And rational explanations can only come from behavioral finance. Of course, they can come from other fields like game theoretic analysis and so on. When we are looking at traditional finance theory, it is anchored on the following four major assumptions. It's anchored on the belief that the market and investors who participate in that market are perfectly rational. Obviously, for the market and the market makers or the market players for them to be perfectly rational, it's imperative that there is free flow of information. There must be free flow of information. Otherwise, if some actors have got more information than others, those with inadequate information may tend to make less than rational decisions. Number two, investors truly care about utilitarian characteristics. So investors are after maximizing their returns, whatever their returns may be. It might be shareholder value, earnings per share, and so on. But it's a utilitarian characteristics that motivate investors. And investors have perfect self-control. In other words, this situation where they are influenced by mobs, or what is called the herding experience within financial markets, does not affect investors. That's one of the assumptions. And then the fourth assumption is that they are not confused by cognitive errors or information processing errors. In other words, these investors are homo economicus who operate almost like faultless or perfect biological computers, if I may put it that way. So in contrast, the behavioral finance makes the following assertions about economic agents or market participants. The first assumption is that investors are treated as normal, not rational. The second assumption is that there are actually limits to their self-control. In other words, their ability to deploy self-control is bounded by certain limitations, such that we have got a situation of bounded rationality or normality, actually. So investors are influenced by their own biases. And then the fourth assumption is that investors may make cognitive errors that can lead to wrong decisions. So behavioral finance acknowledges reality as it were, whilst the traditional finance, makes sweeping assumptions or generalizations about reality. So there are 10 biases that are pointed out by behavioral finance that I just want to cover briefly without necessarily getting bogged down in over-explaining these simple biases. The first bias is called the overconfidence bias, which is a false and misleading assessment of our skills, intellect, or talent. So it's an egotistical belief that we are better than we actually are. Most human beings, they've got this streak, or some human beings, let me just say most human beings, have got this streak of over-evaluating and over-scoring their abilities, which may lead to mistakes when it comes to decision-making in finance. The second bias is the self-attribution bias, which is also called the self-serving bias, which is a tendency in behavioral finance to attribute good outcomes to our skill and bad outcomes to sheer luck. So people will be shifting the blame for bad outcomes to circumstances and situations or chance. And then when good things are taking place, we arrogate those good things to our skills. And then there is the insight bias, which is a misconception after the fact that one always knew that they were right. Someone may also mistakenly assume that they possessed special insight or talent in predicting an outcome. So this is called the insight bias, where a person sort of revises their decision-making in retrospect, and then they overexert themselves in explaining how much they actually knew. And then there is number 4, the confirmation bias, which is a tendency of people to pay close attention to information that confirms their belief systems and ignore information that contradicts their beliefs. This is very common in politics, but may also be found in finance, in the field of finance, economics, and so on, policy making. Wherever people are supposed to make decisions, they might have this confirmation bias, where the cleaning of information and the processing of information is interfered with or colored by certain biases that economic agents might be having. Bias number 5 is the narrative fallacy. This narrative fallacy has to do with our ability to evaluate information objectively, the limitations to our ability to evaluate information objectively is what is called the narrative fallacy. In general, as human beings, we love stories and we let our preference for a good story cloud the facts and our ability to make rational decisions. So we know information about the certain financial indices or certain financial facts. It normally comes with a certain copious volumes of irrelevant information. Sometimes we get bogged down in, over analyzing or over explaining or describing, irrelevant material to the rational decision that we're supposed to make. And then number 6, we've got a representative bias. This is a heuristic bias which occurs when the similarity of objects or events confuses people's thinking regarding the probability of an outcome. People frequently make the mistake of believing that two similar things or events are more closely correlated than they actually are. This is very common where things, sometimes they may tend to move together, but at times the movement in two or more variables may actually be divergent. So where we tend to correlate things which are otherwise are not correlated, which rules of probability do not justify their correlation, we'll be having this bias, which is called the representativeness bias. And then number 7, there is the framing bias, which occurs when people make a decision based on the way the information is presented, as opposed to just on the facts themselves. The same facts presented in 2 different ways can lead to different judgments or decisions from people. Like when a certain piece of information is divorced from its context, like the price of crude oil and financial instruments that are associated with crude oil. If the price of crude oil is presented as rising, as constantly rising, if someone makes a decision to invest in crude oil and the financial instruments that are linked to crude oil, without taking into account that the persistent rise or the continuous rise in the price of crude oil in the past 2 or so weeks has been occasioned by first the threat of Russia's invasion of Ukraine, which was subsequently followed by the actual invasion of Ukraine by Russia. Now, if someone divorces the rise in the price of crude oil from the oil price shock, the determinant which caused the shock in the price, one may make a wrong investment decision. And then anchoring bias, this is bias which occurs when people rely too much on pre-existing information or the first information they find when making decisions. So when making financial decisions, whilst it's important to have background information, sometimes it can color our ability to analyze new information. So new information has to be treated on its own merits from time to time. And then there is loss aversion. This is an aversion which is a tendency in behavioral finance where investors are so fearful of losses that they try by all means to avoid making a loss than on making gains. The more one experiences losses, the more they are likely prone to become loss averse or the more they become prone to loss aversion as a behavior. In general, economic agents are taken to be, risk averse, ceteris paribus. They are taken to be risk averse. And then there is the hedging mentality, which is what I alluded to when I was explaining preliminary concepts. In finance, the hedge mentality bias refers to investors' tendencies to follow and copy what other investors are doing. They are largely influenced by emotion and instinct rather than by their own independent analysis. So, there is the historical background of market efficiency. So market efficiency, also called to the efficient market hypothesis, is a hypothesis in financial economics that states that asset prices reflect all available information. It's one of the most important hypotheses. A direct implication of this theory or hypothesis is that it's impossible to beat the market consistently on a risk-adjusted basis, since market prices of a share or shares should only react to new information, not previously existing information or information in the public domain, so to speak. So because the EMH is formulated in terms of risk adjustment, it only makes testable predictions when coupled with a particular model of risk. And there are so many risk models out there. Some are complex, others are just simple. As a result, research in financial economics from the 1990s has focused on market anomalies, that is, deviations from specific risk models. The idea of financial market returns, the idea that financial market returns are difficult to predict goes back to Behavioural and Mandelbrot, as well as Samuelson. But in recent times, the most influential scholar has been Eugene Farmer, who published his treatise on the efficient market hypothesis. So the efficient market hypothesis provides the logic for modern risk-based theories of asset price determination and diffusion processes. And it provides frameworks such as consumption-based asset pricing and the intermediary asset pricing can be thought of as a combination of a model of risk within the context of the efficient market hypothesis. So research on return predictability has found mixed evidence in support of the efficient market hypothesis, as evidenced by the scholars that are shown on that bullet. Since the 2010s, studies have often found that return predictability is becoming more elusive as predictability fails to work out of SEM or has been weakened by advances in trading, technology, and investor learning. Now, I just want to make a few assumptions in order to sort of motivate for this efficient market hypothesis or for the concept of market efficiency. Suppose a piece of information about the value of a stock, say about a future measure, is widely available to investors in a particular market. If the price of the stock does not already reflect that piece of information, then investors can trade on it, thereby moving the price until the information is no longer useful for trading. So in essence, what is priced in financial markets, the argument is that it's information. The argument is that financial market participants, they try by all means to pounce on new forms of information which they can make useful, from which they can extract whatever gains they can make, as they are trading financial assets. In this scenario that I've just given on the first bullet, we need to observe that this thought experiment does not necessarily mean that stock prices are unpredictable. For example, suppose that the piece of information in question says that a financial crisis has become more likely to take place, maybe due to the oil price shock associated with the Russia-Ukraine war, for instance. Investors typically do not like to hold stocks during a financial crisis, which is why, stock indices, if you check from 2 weeks ago up to yesterday when they began to rebound, like your New York Stock Exchange and so on, and the FTSE, as well as the Hang Seng Index and so on, especially the Standards and Poor's and the American main indices, they experienced a rebound yesterday after they had experienced quite sustained losses. And this is explained by the fact that investors typically do not like to hold stocks during a crisis, not even just a financial crisis, but during a crisis, and particularly during a financial crisis. And thus investors may sell stocks until the price drops enough so that the expected return compensates for this risk. How efficient markets are and are not linked to the random walk theory can be described through the fundamental theorem of asset pricing. This theorem provides mathematical predictions regarding the price of a stock, assuming that there is no arbitrage. Arbitrage, a scenario where someone purchases an asset or a commodity where it is cheap and they sell it where it is expensive, assuming zero transport costs and no trade barriers or any interventions which wipe away gains from arbitrage. That is assuming that there is no risk-free way to trade profitably. So the formal presentation is that if arbitrage does not exist or is impossible, then the theorem of asset pricing predicts that the price of a stock is the discounted value of its future price and dividend, where PT is the price of a stock, which is equal to the expected value given information at time t, and the MT plus 1 is the stochastic discount factor, which is used to discount the future value of the price, because this is price at time t plus 1. If time t is now, the current time, like today, the 17th, then time t plus 1 will be your 17 plus 1, which is 18, which is price tomorrow, plus the dividend tomorrow or in the next period. And T plus 1 is the dividend the stock pays in the next period, which is not necessarily tomorrow. I just used the current time, like the 17th, for illustrative purposes. We know the dividend may be paid after half a year or after quarter a year or at the end of the accounting period, which is at the end of 12 months. Note that this equation does not generally imply a random walk, because it's a straightforward equation with the expectations, the expected value of the discounted value of the future price and the dividend. What is summed in the inside brackets is the future price, which is price at T plus 1, and the dividend, which obviously will be paid in the next period, which is why the subscript is T plus 1. So, however, if we assume that the stochastic discount factor, which is MT plus 1, is constant, and the time interval is short enough so that no dividend is paid, here the aim is to equate T plus 1 equal to 0, because there is no discount which will be, there will be no dividend which will be paid, which means dt plus 1 is equal to 0 within a short space of time. We can't pay a dividend for all practical purposes. So we now have the price of a stock being equal to M, which is the discount factor, expected value at time t of the price in the future of this stock. Now, if we take natural logarithms, or rather, if we take logs, not natural logarithms, and assuming the Jensen's inequality is negligible, we now have, you can investigate from the internet what the Jensen's inequality is. Assuming that the Jensen's inequality is negligible, we get log pt is equal to log m plus e, the expected value of log pt plus 1, which implies that the log of stock prices in the current period follows a random walk with a drift, follows a random walk with a drift. So although the concept of an efficient market is similar to the assumption that stock prices follow the expected value of ST plus 1 given ST, which is equal to ST, which follows a martingale. The EMH does not always assume that stocks follow a martingale. What is a martingale? I may need to just briefly define what is a random walk process is. A random walk process in financial maths or in statistics, it is a financial theory that states that stock prices evolve according to a random walk, so that prices, they change random and thus cannot be predicted. Rather, like a person who is drunk and is walking along a road, they don't follow a trajectory where we can come up with a specific function, a deterministic function to predict their movement. And then a martingale, it's associated with games of chance. In probability theory, a martingale is a sequence of random events that is a stochastic process for which at a particular time, like time t, the conditional expectation of the next value in the sequence is equal to the present value regardless of all prior values. Regardless of all prior values. So if you look at the conditional expectation of the stock price at time t plus 1, given what it is at time t, is equal to what it is at time t, because we assume that the stock price determination process or the behavior of the stock price follows a martingale. So what is market efficiency? Market efficiency refers to the degree to which market prices reflect all available information, that is available and relevant information, which makes it difficult for any market player to beat the market. Because if the market is efficient, then we wouldn't expect undervalued or overvalued securities to exist. And this concept, as I've already noted, is associated with the work of Eugene Farmer, who published a seminal paper entitled The Efficient Market Hypothesis. You can look for that work. He's done a lot of work on market efficiency. And there are degrees of market efficiency, which I just want to cover briefly. The degrees of market efficiency. There are 3 degrees of market efficiency. There is the weak form of market efficiency, which asserts that past price movements are not useful for predicting future prices. If all available relevant information is incorporated into current prices, then any information that is relevant information can be gleaned from past prices is already incorporated in the current stock price. This implies that future price changes can only be the result of new information, not information which is coming from the past. So based on this form of the hypothesis, investment strategies such as momentum or any technical analysis-based rules used for trading or investment decision-making should not be expected to persistently achieve above normal market returns. We don't expect any investment strategy which is informed by momentum or any technical analysis to yield above average market returns. Within this form of the hypothesis, there remains the possibility that excess returns might be possible using fundamental analysis, but not technical analysis. This point of view has been widely taught in academic finance studies for decades, though it's no longer held so dogmatically because of advances in technology and other changes. And then there is the semi-strong form of market efficiency, which assumes that stocks or stock prices adjust quickly to absorb new information so that an investor cannot benefit over and above the market by trading on that new information. There is almost instantaneous adjustment of the stock price to any new information which becomes available. As soon as some economic agents are aware of the information, the market impounds on that information by adjusting the stock price. So this implies that neither technical analysis nor fundamental analysis would be reliable strategies to achieve superior returns, because any information gained through fundamental analysis will be information which is already in the public domain and has been incorporated into the current price of a stock. So only private information unavailable to the market at large will be useful to gain an advantage in trading. Only those who possess such information before the rest of the market does are likely to gain. The strong form of market efficiency says that market prices reflect all information, both private and public. This is the strong form. Building on and incorporating the weak form and the semi-strong form. Given the assumption that stock prices reflect all information, public as well as private, this implies that no investor, including a corporate insider, will be able to benefit above the average investor, even if he or she were privy to new insider information. So insider trading under the strong form of market efficiency does not work. So that's that. And then we want to really see whether financial markets are really efficient, for instance, stock markets. First, we know that financial theories are subjective. They are not proven laws that are cast on stone like the law of gravity, because they are laws that are meant to describe the behavior of human beings in financial markets, which has got a lot of psychology to it. So there are 3 tenets to the efficient market hypothesis, which are the weak, the semi-strong, and the strong. which I've already covered. So there's no need for me to rehash that. So the problems associated with EMH, first, it assumes that all investors perceive all available information in precisely the same manner. In other words, it makes our investor homo economicus. It homogenizes all investors, which may not be actually true. If one investor looks for undervalued market opportunities, while another investor evaluates a stock on the basis of its growth potential, these two investors will already have arrived at a different assessment of the stock's fair value. So this is one thing. There are bears and bulls in the market. That much we know. So for that reason, we can't assume that all investors perceive all available information in precisely the same manner. Second, no single investor is ever able to attain greater profitability than another with the same amount of invested funds under the efficient market hypothesis. Since they've got the same information, they can only achieve identical returns. But if we consider a wide range of investment returns by the entire universe of investors, investment funds, and so forth, if no investor has any clear advantage over another, would there be a range of yearly returns in the mutual fund industry from significant losses to 50% profit or more? So according to EMH, if one investor is profitable, it means every investor has to be profitable. But then how would Warren Buffett be able to sustain positive profits whilst other investors incur losses to the point of bankruptcy? And then thirdly, and closely related to the second point, which I've just enacted, under the efficient market hypothesis, no investor would be able to beat the market or the average annual returns that all investors and funds are able to achieve using their best efforts or best bets. The natural implication of that is that the absolute best investment strategy is simply to place all of one's investment funds into an index fund. This would increase or decrease according to the overall level of corporate profitability or losses. But there are some investors who have consistently beaten the market. In the 1990s, there was George Soros, and from a long time ago up to the present, Warren Buffett has managed to outpace the averages year after year. It's something which needs to be explained. Are the markets efficient or inefficient? Then one may also qualify the EMH by saying, with the advances in technology, information technology, there will be increasing market efficiency with the passage of time. So I believe that though I was moving quite fast, I've done justice to what I was supposed to cover in this brief exposition of the efficient market hypothesis. For those that I'm teaching central banking and monetary economics, I'm going to share with you my brief notes. You can also use your notes from corporate finance as well as from financial economics as well to rejig your understanding or to revive your understanding of the efficient markets hypothesis. The reason why I didn't cover it in granular details is because you covered it in so many modules, and those who did degrees in banking and investment management or finance, you covered it in several modules like corporate finance and so on. So I didn't see any need for me to belabor this fundamental, hypothesis about financial markets, which is covered in most finance programs or financial economics programs. So without much wasting of time, I thank you so much as I conclude this lecture.